Goldman Sachs' updated USD forecast reveals striking new levels for the Turkish Lira. Their 3-month target stands at 35 Lira per US dollar, signaling steady Lira depreciation ahead. This forecast sharply impacts crypto investors tracking emerging market currencies amid global volatility. The predicted slide to 38 Lira in 6 months and 40 Lira in a year underscores persistent inflation and external financing challenges in Turkey. For crypto portfolios linked to Bitcoin and DeFi projects exposed to Turkish markets, the USD trajectory could influence token valuations and liquidity flows. Understanding the driving forces behind this outlook is vital for positioning your investments strategically now. Turkey's ongoing battle with high inflation heavily reforms its monetary policy, leading to aggressive interest rate hikes by the Central Bank of Turkey, CBRT. Goldman Sachs factors this effort when projecting slower but steady depreciation of the lira over the next 12 months. If inflation deepens or monetary policy falters, the lira faces renewed downward pressure, affecting local cryptocurrency adoption and cross-border trading pairs. Soon, more details will explain how the central bank's foreign exchange reserves could buffer this volatility, influencing both fiat and stablecoin stability. Another critical driver is Turkey's persistent current account deficit, financed mainly through foreign capital inflows. Should global risk appetite wane or capital flight intensify, the demand for USD versus TRY will surge, weakening the lira further. Crypto investors must remain alert, as fluctuations in USD-TRY exchange rates directly impact valuation conversions and remittance costs within blockchain networks tied to Turkish assets. Optimizing portfolio strategies requires factoring in these cross-market interconnections. Stay tuned for analysis on how geopolitical tensions in the region compound these economic risks. Turkey's unique geopolitical position subjects it to increased uncertainty from regional conflicts and shifting alliances, adding a risk premium to the Turkish lira's market valuation. Political instability undermines investor confidence, triggering capital outflows that depress the currency. The resulting volatility challenges Turkish-based crypto businesses navigating regulatory frameworks and currency hedging. For traders, this unpredictability demands vigilance, especially with Bitcoin's role as a hedge in emerging markets gaining prominence. Later, we will break down how geopolitical risks translate to crypto market impacts. Furthermore, the Central Bank of Turkey's level of foreign exchange reserves plays a crucial role in curbing market volatility. Healthy reserves enable intervention in currency markets, possibly stabilizing TRY and supporting confidence in Turkish stablecoins and blockchain payment systems. Conversely, dwindling reserves risk exacerbating currency depreciation, intensifying pressure on crypto projects reliant on TRY liquidity. The Goldman Sachs forecast implicitly evaluates these reserve trends, hinting at potential intervention capacity shifts. Remember, this affects more than just Forex. It influences broader crypto market sentiment tied to emerging economy exposure. Foreign investors holding Turkish assets confront complex currency risks as the lira depreciates. Equity stakes in Borsa Istanbul may lose value in USD terms despite nominal gains. Similarly, high-yield Turkish government bonds carry hidden currency depreciation risks, eroding real returns. Crypto investors engaging with Turkey-oriented DeFi protocols must also consider currency volatility impacting cross-border capital flows and smart contract valuations. Businesses with dollar-denominated debts face mounting repayment burdens, potentially affecting operational stability in crypto ventures. How you hedge these exposures can define your investment resilience. On the flip side, importers incur steeper costs due to lira weakness, influencing token pricing when pegged locally. Exporters might gain competitive advantages, possibly spurring blockchain adoption in Turkey's export sectors. Tourism benefits from lira depreciation, increasing foreign visitor inflows and potentially boosting blockchain travel apps. Individual Turkish citizens see diminished purchasing power, creating challenges but also opportunities for crypto to act as an alternative store of value. These nuanced effects require investors and entrepreneurs to continuously reassess market positioning amid unfolding macro dynamics. Emerging market currencies like the Turkish lira typically exhibit sharp volatility influenced by global interest rate shifts, commodity price swings, and political developments. Rising U.S. Federal Reserve rates attract capital back to dollar assets, pressuring emerging market FX pairs including USD-TRY. For crypto traders, monitoring these macro factors alongside technical indicators provides a clearer risk picture. Hedging strategies utilizing options or forward contracts can protect portfolios against sharp currency moves. A diversified global crypto portfolio is an effective shield, balancing emerging market growth with reduced single market exposure. Current FX trends highlight divergent central bank policies worldwide. While the CBRT hikes rates to fight inflation, other central banks may loosen, creating cross-currency yield gaps fueling carry trades and capital flows. This environment affects not only traditional forex, but also stablecoins anchored to fiat currencies like USD and TRY. Inflation persistence, geopolitical risk premiums, and commodity volatility add complexity to these movements. Crypto communities need to track macroeconomic signals closely, since blockchain market behavior increasingly reflects global liquidity shifts and monetary policy outlooks. The US dollar's overall strength remains a fundamental force, shaping the USD-TRY pair. As the primary reserve currency, the dollar's movement impacts emerging market currencies, crypto asset valuations, and international liquidity. Fed policy announcements and inflation data can cause rapid USD appreciation or weakness episodes, influencing Turkish Lira depreciation speed. Understanding how these dynamics interplay with crypto assets like Bitcoin, stablecoins, and DeFi yields empowers investors with foresight to time entries and exits for maximum returns. With Goldman Sachs's USD-TRY forecast announcing targeted depreciation levels, it is crucial to reevaluate your Turkish Lira exposure immediately. Hedging with forward contracts or crypto derivatives can safeguard against unexpected swings. Businesses should scrutinize supply chains, import pricing, and foreign currency debt profiles to avoid margin erosion. Crypto traders must stay updated on CBRT policy changes and geopolitical developments that might alter this outlook swiftly. Remember, agility and informed risk management are essential to navigating these volatile currency waters. Before making any moves, diversify your portfolio internationally to cushion against idiosyncratic shocks. Keep a long-term perspective, acknowledging that emerging markets present volatility but also significant growth potential for crypto asset adoption. Stay connected with real-time economic data, geopolitical news, and Fed policy signals for a comprehensive market understanding. Think about how Turkish regulatory frameworks might evolve alongside these currency trends, further shaping cryptocurrency project viability. If you found these insights valuable, like and subscribe for more expert crypto market analyses. Share your thoughts on USD-TRY forecasts and crypto impacts in the comments below. Staying engaged helps build a community prepared to tackle emerging market crypto challenges together. Ultimately, Goldman Sachs's USD-TRY forecast marks a pivotal moment for crypto investors intertwined with Turkish economic cycles. It highlights how traditional finance projections powerfully influence blockchain markets worldwide. Remaining informed, diversified, and proactive will determine success in this complex arena. The Lira's path forward is fraught with challenges, but also ripe with opportunity for those who understand the shifting landscape deeply.